There is a raise coming to your Social Security check. You may have already heard about it, and I need to tell you the truth about that raise before you spend a single dollar of it, because there are 3 things happening to your check right now. Not next year, not someday, right now. The first one takes most of that raise back before it ever reaches your bank. The second one is a surcharge you never signed up for, built on money you earned 2 years ago. And the third one can cut your check off completely if you do nothing. Here is what makes all 3 dangerous. Every one of them was built to happen quietly. No phone call, no warning letter in big print. You are supposed to find out the month your check comes up short, and by then the money is already gone. And the timing is what makes this the moment to watch, because these are not old rules gathering dust. The pieces are landing now, this season, these very months. The raise, the surcharge notices, the end of the paper check. They are arriving on kitchen tables across the country as we speak, which means the window to get ahead of them is open right now, not next year. This is the summer to sort it out, while you still have every choice in front of you. Now stay with me because there is one more thing. For one of these 3, most of the people who get hit already qualify to stop it completely. They qualify today, and almost none of them ever file the paperwork because nobody told them the paperwork exists. Before this video ends, I will tell you which one and exactly where the fix is hiding. My name is Nancy Ahad. I read the rules so you do not have to. If you are new here, this channel exists for one reason. We read the fine print that decides what happens to your money, so you find out before the system decides for you. Subscribe and turn on the bell because at least one of these 3 is going to touch someone you love. Let me start with the first one because it wears a disguise. It shows up dressed as good news. Every year they announce a raise to Social Security. They call it the cost of living adjustment. Verified card source Social Security Administration SSA.gov COLA. Confirm current year COLA percentage before recording. And every year, millions of people see that headline and feel a small breath of relief. A little more coming in finally. But here is what they do not put in the headline. The single biggest health cost most seniors have. The Medicare Part B premium is pulled directly out of your Social Security check before you ever see it. Verified card source Medicare.gov. Part B premium deducted from Social Security benefit. You do not pay it. You do not write a check for it. It is simply taken off the top automatically every month. And here's the trap. That premium goes up too. So when your raise arrives, the premium increase reaches into the very same check and takes a piece of the raise right back out. Some years the premium goes up almost as much as the raise. Verified card source Centers for Medicare and Medicaid Services. Confirm current year Part B premium figure before recording. Some years, for some people it takes nearly the whole thing. So, you were told you got a raise, but the number at the bottom of your check, the number that actually lands in your account, barely moved or did not move at all. That is not an accident. That is arithmetic. And nobody explains the arithmetic to you. And it goes deeper than one premium. The raise itself is built on a measurement that was never designed around you. The cost of living adjustment is tied to a basket of prices, and that basket leans heavily on the things working people buy. Gas for the commute, everyday goods. It does not lean on the things that actually drain a senior's budget. Medical care, prescriptions, the cost of keeping a roof over your head as you age. Verified card source COLA index to a general price measure, not senior-specific costs. So the prices that hit you hardest rise faster than the raise that is supposed to cover them. Which means even before the premium ever touches it, the raise was already behind every single year. By design, the raise is not keeping you even. It is helping you fall behind a little more slowly. Let me tell you about Roscoe. Roscoe is 72. He lives in Zanesville, Ohio. He drove a delivery route for a bakery for 31 years. Same roads, same houses every morning before the sun. When the raise was announced, Roscoe did what a lot of careful people do. He sat down at his kitchen table with a pencil, and he did the math on what his new check should be. His old check was about $1,800 a month. The raise was supposed to add a little over $40 to that. Snorts, $40. To Roscoe, that was the electric bill in the winter. That was real. Then the first new check came in. He looked at the number, and it was almost exactly what it had been before. Not $40 more, barely a few dollars more. He thought he had made a mistake with the pencil. He did the math again. The math was right. The raise was real. It just never reached him. Because the Part B premium had gone up by nearly the same amount at the very same time, and quietly swallowed almost the whole raise before it ever left the government's hands. The raise gave him $40. The premium increase took back most of it. What actually landed in his account was a few dollars, on a whole year of headlines about a raise. Nobody sent Roscoe a letter that said, "Your raise has been taken back." They sent him a letter that said, "Congratulations on your raise," and a separate, quieter notice about the premium that he never connected to the first one. 2 letters written so you would never lay them side by side. Now some of you are thinking, "Nancy, there is a rule that protects the raise. I have heard of it." You are partly right, and this is exactly the kind of thing they count on you being only partly right about. There is a protection. It is meant to keep the premium increase from being larger than your raise, so your check never actually goes backward. Verified card source Social Security Administration hold harmless provision. But listen closely, because this is where the comfort ends. That protection does not cover everyone. It does not protect people in their first year of Medicare. It does not protect people whose income is high enough to carry that surcharge I will get to in a minute. And even when it does apply, it only promises your check will not shrink. It says nothing about your raise actually reaching you. Let me tell you about Gladys. Gladys is 69. She lives in Tupelo, Mississippi. She kept the books for a lumber yard for most of her working life. Numbers do not scare her. And that is what made it worse, because Gladys checked her math 3 times. And 3 times it told her the same impossible thing. Her new check, the one that came after the so-called raise, was smaller than the one before it. Not the same, smaller. Because in her case, the piece of the premium she carried went up by more than her raise did, and the protection did not reach her situation. She got a raise on paper and less money in her hand, both at once, and nobody could give her a straight answer about why. Now, here's the part I need you to hear, because this is where it stops being sad and starts being useful. That premium, the one eating your raise, is not the same amount for everyone. For a large number of people on a fixed income, there is a program whose entire job is to pay that Part B premium for you. Verified card source, Medicare savings programs, QMB, SLMB, QI, Medicare.gov pay it entirely. So the money that was being pulled off the top of your check stays in your check. And it is not just one program. There are levels to it. There is a level that covers more for people with the least. There is a level that covers the premium for people a little above that. There is even a level for people higher up still, which means the line to qualify is further up than most people assume. Many who are certain they earn too much do not, and here is what trips people up the most. They hear the word program and they picture years of poverty and a stack of humiliating paperwork. That is not what this is. The income lines are higher than most people guess. And what they count and what they leave out is not always what you fear. People rule themselves out in their own heads and never even ask the question. And ruling yourself out is free to the government. It costs them nothing when you decide all on your own that you must not qualify. Do not be your own gatekeeper here. Let them be the ones to say no. Very often they will not. And this is the one I promised you at the start. Remember that because the vast majority of the people who could have that premium paid for them never sign up. Verified card source Medicare Savings Program enrollment gap. Confirm current under-enrollment figure before recording. They qualify. The relief is sitting right there, and the check keeps getting cut for one reason. Nobody told them to ask, nobody handed them the form, nobody said the words out loud where they could hear them. Roscoe qualified the entire time. Clears throat. Every winter that he chose between the electric bill and something else, the money to cover that premium was already his to claim. He just never knew there was a door, let alone where to find the handle. And that is exactly why I built the thing I am about to tell you about. Because the relief in this country is almost never the problem. The problem is that the relief is written in a language designed to make you stop asking. The exact program name, the exact form, the exact income line they check, the level you actually fall under, the exact sentence to say on the phone so you are not bounced from office to office for a year. That is what the quiet rules is. It is the drawer version of everything I cover on this channel. Written large, written simple, so the person sitting at the kitchen table with a letter they do not understand knows what to do on the first day, not a year later. The paper remembers for you. That is the entire point of paper. The link is right below this video, or scan the QR code on your screen right now. It is also in the pinned comment at the top. And there is a 7-day guarantee always. If it does not hand you something you did not have before, you send it back. Scene, because the alternative is another winter of Roscoe at that kitchen table, pencil in hand. Scene, doing math that always comes out the same way. Short scene, if this is the first time anyone has told you that your raise is being quietly taken back, senior, do me one favor. Subscribe and turn on the bell, because this channel reads the fine print that nobody mails to your house. So that is the first hand reaching into your check. The one dressed up as good news. Now, let me show you the second. And this one does not bother with the disguise at all. See? Now, the second change. And if the first one made you a little uneasy, this one is going to make you sit up straight, because this one reaches back in time. The government can raise the amount taken out of your check based on money you earned 2 years ago. Verified card. Source: Social Security Administration and CMS. Income-related monthly adjustment amount IRMAA 2 years ago, not this year, not last year, the year before. Let me explain how this even works, because most people have never heard the word for it. It is called the income-related monthly adjustment amount. Most people just call it a surcharge. Here's the idea. If your income was above a certain line, the government decides you can afford to pay more for your Medicare, and they add a surcharge on top of your premium. And where do they pull that surcharge from? The same place. Straight out of your Social Security check, and it climbs in steps. The higher the income they are looking at, the higher the surcharge. It does not ease in gently. You can cross a single line by a small amount and jump to the next step all at once. A few dollars of income over a line can cost you far, far more than a few dollars in surcharge. Let me put that in plain terms so it lands. Imagine two neighbors. One of them has income just under a surcharge line. The other is just over it. That small difference does not add a small amount to the second neighbor's cost. It can add hundreds of dollars across the year, sometimes more than 1,000 for stepping over one line by a little. Verified card source CMSAA is a cliff, not a gradual slope. Confirm current year bracket amounts before recording. That is what a cliff is. Not a ramp you ease up, a ledge. You step off. And most people never know the ledge is even there until they have already gone over it. Now, here is the part that catches good, careful people completely off guard. They do not look at what you make now. They look back 2 years, because that is the last full tax return they have finished reviewing. Verified card source CMS IRMAA, a 2-year look back. So, a single good year 2 years in the past can raise the amount taken out of your check today, even if your income has since dropped to almost nothing. And it is very often a one-time thing that does it. You sold a house, you finally took a bigger withdrawal from your retirement account, you cashed in an old policy. You had one strong year before you fully retired. For 1 year on paper, your income looked high. That year is gone. That money is spent. But the surcharge shows up 2 years later, and it takes its cut every single month. Let me tell you about Maybelle. Maybelle is 74. She lives in Boone, North Carolina. 2 years ago, she did something completely reasonable. She sold the family home. It was too big, too many stairs, too much yard. That sale for that 1 year made her income look large on paper. On paper only. She used most of it to move into a small place near her daughter and had little left over. This year, her Medicare surcharge kicked in, a new amount taken out of her check every month tied to a house she does not even own anymore. She called Medicare confused. She was sure it was a mistake. It was not a mistake. It was the rule working exactly as written. And the surcharge does not know that the money is long gone. It only knows what the tax return said 2 years back. And there is a second way this one strikes, and it is crueler. It hits widows. Let me tell you about Juanita. Juanita is 71. She lives in PBLO, Colorado. Her husband passed last year, and in her grief, something happened to her taxes that nobody warned her about. While there were 2 of them, they filed together, and the income line the government uses to decide that surcharge sat comfortably below the trouble. But when you lose your spouse and you begin filing as one person, that line drops. It comes down sharply. So the very same household income that was perfectly fine when there were two of them can now push a widow over the line all by herself. Juanita lost her husband, and then months later the government reached into her check and took more for the arithmetic of being one person instead of two. She did not earn more. She had less coming in, not more. But the rule does not see grief. It only sees which line you file under. And think about the timing of it. The surcharge does not arrive in the worst month when the loss is fresh. It waits. It arrives quietly a year or more later, long after the casseroles have stopped coming, and the phone has gone quiet when she is alone and least expecting one more blow. That is not cruelty by design. It is worse than that. It is cruelty by indifference. The rule simply does not care. Now, here's what I need you to hear, because this is the part almost nobody uses. Most people who get that surcharge notice assume it is final. A machine printed it. What can you do? That assumption is the most expensive one in this entire video, because there is a specific process for exactly this. If the reason your income looked high was a life event, you retired, you stopped working, you lost your spouse, you sold a property once and will never again, there is a way to tell the government that was then. This is now recalculate me on the life I am actually living. Verified Card Source Social Security Administration Life-Changing Event Determination Form SSA 44. There is a form for it. There is an actual list of life events that qualify. Work stopping, marriage changing, the loss of a spouse, the loss of income-producing property, and more. And there is a window to file it in. And when it works, the surcharge comes off. The check comes back up, sometimes going all the way back to the month it started. People win these, but only the people who file them. And here is something almost no one realizes. You are not out of time just because the surcharge already started. You are not out of luck just because you have already been paying it. The door does not slam the moment the first payment comes out of your check. But it does not stay open forever either. Every month you wait is a month of your own money you may never get back. So the mistake is never filing too soon. The mistake is always the same one, believing the letter was final and doing nothing at all. And almost nobody files them, because the notice that raises your check does not come with the form that lowers it. It never does. That is the whole game. Think about what this one thing is worth. For someone like Maybelle or Juanita, that surcharge is not a few dollars a month. Held across the years, it stays on the check. It can run well into the thousands. Thousands of dollars taken for a house already sold or a husband already buried. And the thing standing between that money and their pocket was not eligibility. It was one form nobody handed them. That is exactly what the quiet rules holds. The list of life events that qualify, the exact form, the window you have to file it in, the sentence that gets it taken seriously the first time instead of the third. For this and for every rule in this video, sitting in the drawer, in plain English, before the notice arrives, not after. Because the alternative is a widow like Juanita alone at the counter opening a notice she does not understand and simply paying it month after month because she believed the letter was the final word. It is not the final word, but only if you know that before the clock runs out. And if you want me to look at your own situation directly, email me. The address is on your screen and in the description below. I read every one. Now the third change, and this is the quietest of the three, which is exactly why it will catch the most people. The paper check is ending. Verified Card Source U.S. Department of the Treasury phase out of paper checks for federal payments. Confirm current phase-out date before recording. For decades, tens of millions of Americans have received their Social Security the same way. A check in the mailbox on the same day every month. Something you could hold in your hand. The federal government is ending that. They are moving every federal payment to electronic only, direct deposit into a bank account or onto a government-issued prepaid card. Now, why are they doing this at all? Two reasons they will tell you, and they are not lies. Paper checks get lost. Paper checks get stolen out of mailboxes, and a paper check costs far more to send than an electronic payment does. Verified card. Source: U.S. Department of the Treasury. Paper check fraud and cost. A stolen check can take weeks and a mountain of paperwork to replace. An electronic payment cannot be lifted out of a mailbox. So, on paper, the change protects you. Think about that for a moment. A paper check sitting in a rural mailbox on the same predictable day every single month is a target. People know when it comes. People know exactly what it is. For years, the most vulnerable payments in this country have been the paper ones, because a paper check can be stolen, forged, and cashed before you even know it was taken. And then you are the one filing the reports and waiting, sometimes for months, for a replacement. So the move to electronic is not the enemy here. In plain terms, it is the safer road. The enemy is being caught off guard by the change with no plan on the very month the paper finally stops. But this one is not about the people it protects. It is about the people who never trusted a bank. The people out in rural counties where the nearest branch closed years ago. The people who have always their whole lives held the paper in their hand. Let me tell you about Delmar. Delmar is 78. He lives outside Webo, Montana. If you do not know the name, that is exactly the point. It is a long way from anywhere. Delmar has never had a bank account, not out of stubbornness. There simply was never a bank close enough to matter, and the paper check always came and it always worked. Now Delmar is being told the paper is going away. And the fear underneath that for a man like Delmar is simple and total. If the paper stops and he has no account for an electronic payment to land in, does the money just stop coming? Here is what he was never clearly told. You do not actually need a bank to receive the money electronically. The government offers a prepaid card that the payment loads onto every month. You use it like any bank card at the store, at the machine that gives out cash. No bank branch required. Verified card. Source: U.S. Department of the Treasury. Direct Express card. Confirm current program details before recording. For a man like Delmar, that one fact changes everything. But nobody drove out to Webo to explain it to him. And beyond even that, there is a path for the people who truly cannot manage any of it. There is a hardship exception, a waiver for people for whom going electronic is a genuine burden. Remote, no access, unable to manage it. Verified card source, U.S. Department of the Treasury. Electronic payment hardship waiver, confirm current process before recording. But hear me, that waiver is not automatic. Nobody signs Delmar up for it. The exception exists on paper in an office far away, and it only protects the people who claim it in time in the right way. Let me tell you about Hattie, too. Hattie is 80. She lives in Bogalusa, Louisiana. The people who get hurt by this are not the people who chose wrong. Thanks for watching.